Bismillahirrahmanirrahim. Assalamu alaikum and very good day to all of you. I hope that everyone is doing fine at the moment. The topic of today's lecture is inventory as money. Before going into this particular chapter, I just wanted to give you a brief idea regarding the background and the significance of this particular chapter. From the name of this chapter, you can already identify that we're going to value the inventory in terms of the monetary value. Now, why would you do that? What is the importance of actually doing this one? As you all know, that a very common term actually being used in the financial analysis, that is what we call ROA. And in brief, if I want to give you the brief description of ROA, that means the return on assets. So that means how much return you might get from the asset of you have currently as inventory in your organizations. Basically, it shows how much return again the organizations might get from the inventory. And again, why you actually need to show this one? You need this amount of return you get from your inventory because of your tax purpose. Because at the end of the year, you have to actually pay the tax to the government, and a significant amount of money you have to actually pay for the assets you have. Right. So if you go to the first slide of the lecture, it says that in order to assign the cost value to inventory, we must take some assumptions about the inventory on hand. So you have to take some kind of assumptions about the inventory on your hand. Under the federal income tax law, a company can only make these assumptions once per fiscal year. Tax treatment is often a very important concern, or I would say the chief concern of any organizations. So to value the inventory, in general, the organizations actually used 5 different methods, and these particular methods actually come from the accounting methods. And if I want to tell you what are the 5 methods normally an organization being used in terms of value the inventory, that is first in, first out. Second one is last in, last out, or LIFO. Average cost method, specific cost method, and the standard cost method. Now I want to give you the brief idea about these 5 methods, what we normally been used for the inventory valuation. Now, if you look at the first one, it says that first in, first out. Inventory valuation assumes that the first good purchased are the first to be used or sold regardless of the actual timing of their use or sale. So if I want to explain this particular term, that means that the inventory you actually purchased first, you have to show this inventory actually being sold at first price, I mean the first purchase price, regardless of the actual time of the use or actual time of the sale of this inventory. Again, I am saying it is not going to show you the profit you are getting out of this. It is just only valuing the inventories what you have. So that means you just need to show the first purchase price as a first sale into your organization. This is basically what you call first in, first out. So the second one is exactly the opposite of the first one. It says that inventory valuation assumes that the most recently purchased goods are the first to be used or sold regardless of the actual timing of their use or sale. So as I told you before, that it is the opposite of the first one. The first one, first in, first out. So that means you are taking the purchase price which comes actually first in terms of selling the product. So in the second one, LIFO, you have to actually take the last purchase price as your first selling price. So that means the last in, first out. The third one, right, the third one of the inventory valuation method is average cost method, which is the inventory valuation identifies the value of inventory and cost of goods sold by calculating an average unit cost for all goods available for sale during a given period of time. So in this particular method, we are not taking the individual purchase price. We just try to get the average purchase price from your inventory, and then you show this particular average price as you're selling the inventory or as the valuation of the inventory. Right. The fourth one is the specific cost method, which is also known by the actual cost method, which is inventory valuation assumes that the organization can track the actual cost of an item into, through, and out of the facility. So in this particular method, the organization actually take each and every individual cost which is actually been incorporated in terms of purchasing the price. The last one, the standard cost method, and the standard cost method defines that each and every most of the organizations, I would say like few organizations or manufacturing companies actually give the valuation to the inventory a uniform value to all of the departments. So they actually set a uniform value across the overall all the departments of the organization, and they set the price for selling the inventory or to value the inventory. Right. So inventory balance sheet and income statement, or I would say the inventory on balance sheet and income statement, how we actually show the inventory on our balance sheet or income statement. This is actually come from very basic principle of the accounting, which is assets is equals to liabilities plus equity. So I believe that everyone of the business students actually know this particular principle, because this is the basic principle of the accounting, and only one formula you need to use to calculate or to value the inventory under the accounting methods. That is, the ending inventory is equals to beginning inventory plus the purchases minus the cost of goods sold. So if you look at this particular equation or this particular formula, you can see it says the ending inventory, which is normally been expressed by the units. Beginning inventory is also expressed by the units plus the purchases, that means how much inventory you are actually purchasing. But the last one, it says that cost of goods sold. So obviously we can actually add or subtract by adding two different kind of units, which is the unit and also the cost. That's exactly why we try to convert all of the unit or all of the inventories into the money value. So how much money you actually have for your beginning inventories and the purchases, and then you have to actually minus the cost of goods sold, so that you can find the value of the ending inventory in terms of the monetary value. So basically when we actually do an example, it will be really easier for you to understand that how we actually use this particular methods, or how we actually calculate this method in terms of evaluating our inventory. So if you look at your lecture slide, you'll definitely find that one method is actually given for example to identify the FIFO, LIFO, and average cost method. So before going into the solution of the math, I just want to briefly explain what actually been asked in this particular example. So you are asked to evaluate the inventory by using FIFO, LIFO, and average cost method. Now you can see there's two tables actually given there. One identified how much unit you purchased, and another one is the unit sold. So if you look at the different columns of this particular table, you will find that the date is actually given. The date actually been given here in American style, so that's why the month comes first. Then the number of the units and the cost of that particular units on that time that you purchased, and that is the total cost. So different dates actually been given here for the purchase of the units in different times. If you look at the second table, it says the units sold. That means how much unit or how many units actually you sell during this particular amount of time. So that the dates are given, the amount of units are also given. That means this amount of units you actually sell on this particular amount of this particular date. So again, what I'm saying, that is, it is not the actual selling price, it is just the inventory valuation price what you want to show into your balance sheet at the end of year, so that you can gain some kind of idea regarding your tax payment to the federal government. So in the next slide, I will show you how to actually solve this particular mathematics by using three different methods. So while I'm actually going to solve this particular mathematics, make sure that this slide is actually open, so that you can understand what I'm actually going through. So so obviously this time, as we are not having any whiteboards or like any other facilities during the class, what we normally get, so I want to show you how to do this one in Excel sheet. So obviously if you find any kind of difficulties in terms of understanding that, you can always give me a buzz to make sure that what you actually don't understand. So the next part of the lecture, I will show you how to solve this mathematics by using the Excel sheet. Thank you.